So good evening everyone. Today we are going to start marginal costing. The marginal costing comprises of two words, marginal and costing. Marginal, what do you mean by marginal? Marginal means additional, very small addition. Very small addition. So it means in costing, in marginal costing, we will understand the impact of increase in one unit. What will be the impact in cost if we increase one unit? Okay. So here, what are the topics that we are going to study? Concept of marginal costing, concept of marginal costing, then CVP analysis. CVP analysis, it means cost, volume and profit. So in CVP analysis we will learn the relationship of cost and volume with profit. CVP analysis. So break even, next is break even chart. Break even chart and profit chart. The next will be multiple product break even analysis. Multiple product break even analysis. Then differential cost analysis. Then marginal costing versus absorption costing. This is a very easy chapter but a very important chapter. It is in your CMA final, CMA inter as well as CMA final. So you have to do this chapter very cautiously. Concept of marginal costing, today we will cover this. We will try to cover all these things in the class 1. Today we will cover this, including all the formulas we will try to write down, which you have to always check when you go for your exams. In CMA inter, CMA final, whenever you go to exams, you have to go through the formulas and formulas. Then in second class we will try to do this. In third class we will do some practical questions. So but you have to practice the practical questions at home, so that you can, if there is any doubt, you can ask me, or we can, you can understand, so you can assess your understanding from the practical questions, because in exam I think this chapter will cover mostly practical questions. So first you write down the formulas. You write down in a page. All should write down. Marginal cost equal to variable cost. Marginal cost equal to variable cost. So whenever we are speaking of marginal cost in this chapter, we mean only variable cost. Variable cost may be direct labor, direct material. It means direct labor, direct material, and other direct cost. So your first thing you need to know is that marginal cost means variable cost. Variable overhead. So marginal cost equal to variable cost, and it includes direct labor cost, direct material cost, direct expenses, variable overheads. Okay. Number 2, contribution. Next is contribution. Contribution equal to sales minus variable cost. Sales minus variable cost is your contribution. Then it is not complete. Equal to fixed cost plus profit. It's okay. So the question may come from this part, or the question may come from this part. Okay, the question may give you fixed cost and profit, and it may require you to find out contribution. The question may give you fixed cost and contribution, and it will require you to find out what? Profit. The question will give you sales and contribution, and it will ask you to find out what? Variable cost. The question will give you variable cost and sales, it will require you to find out contribution. So it may give in different permutations and combinations, but these are the things that will be given to find out your contribution. So these are the 2 points. Contribution equal to sales minus variable cost equal to fixed cost plus profit. To simplify this, we can say what? Sales minus variable cost minus fixed cost. It is what? Profit. It is right. Simple. It is very easy. So this question, this formula number 2 is very important. Contribution equal to sales minus variable cost equal to fixed cost plus profit. Okay, we'll go to the third. Third is your profit volume ratio. Third formula. Please note down those online. Those online, please note down these formulas. It is very important, and if you note down in your copy, you can revise them at a single glance during your exams. Okay. Profit volume ratio. Profit volume ratio, it is equal to contribution per unit by contribution per unit by selling price per unit. Okay. So it can also be derived from various other related formulas. contribution by sales. Okay, here we had per unit, now here it is contribution by sales into 100. It can also be found out change in contribution divided by change in sales into 100. It can also be found out by change in profit by change in sales. So these are all derived formulas. The main formula is this. Okay, we have from this formula we have derived this contribution. We have removed when per unit figures are not given, then we total figures are given, then we divide the total figures. Contribution of two different years are given along with sales of two different years, year 1, year 2, year 1, year 2. Then we subtract them, change in sales by change in contribution by change in sales. Then if profit and sales are given, then this is the formula. So these are all derived formulas. The main formula is this that you need to know. Then break even point. Number 4 is break even point. What is your break even point? Fixed cost into sales plus sales hobo no. Fixed cost break even point, let me see. Fixed cost into sales. Fixed cost into sales by sales minus variable cost. So this is the main formula for BEP. You should note it down. Okay, break even point equal to fixed cost into sales by sales into sales minus variable cost. Now we all know from formula 2, sales minus variable cost is your contribution. So you can also write fixed cost into sales by contribution. If sales and variable cost are not given but directly contribution is given in your question, then you can write fixed cost into sales by contribution. Then fixed cost into sales by contribution is again known as what? In earliest formula number 2 we knew that contribution is also known as fixed cost plus profit, right? So if any of these figures are given in the question, you can find out what? BEP. Of course, one more point is there. Fixed cost by PV ratio. That you don't require. Then number 5 is margin of safety. Margin of safety. What do you mean by margin of safety? Margin of safety means any sales that you make above the break even point. Say your break even point is 100, so you made a sale of 110, so the 10 is your margin of safety. It is total sales total sales minus BEP sales. Okay, margin of safety sales is total sales minus break even sales. So it is your margin of safety. Then the next type of questions that may arise leads to sales value. Sales value to earn desired profit. How much? It will be fixed cost. Fixed cost plus desired profit. Desired profit by PV ratio. It's okay. These 6 formulas, if you learn, then you can complete the entire chapter of marginal costing. So first formula, marginal costing is equal to variable cost, then contribution equal to sales minus variable cost equal to fixed cost plus profit, then PV ratio equal to cost per contribution per unit by selling price per unit, break even point equal to fixed cost into sales by sales minus variable cost, then margin of safety equal to total sales minus BEP sales. Sales value to earn desired profit equal to fixed cost plus desired profit divide by PV ratio. So we will start with 3.1. Marginal costing is a technique applicable to the existing methods to find out the effect on profit or if changes are made in the volume of output or in the type of output. Marginal costing helps management to take various routine and special or crucial decisions. Marginal costing always helps management to take important decisions. If a product is meeting its variable cost, we may continue its production if same facility, if it can be produced in the same facilities. If we do not require any additional fixed cost, then we can continue its production. This is what the concept of marginal costing says. To continue with a product or not, to change the selling price if even if it is not meeting its variable cost, then we should increase the selling price, or we can decrease the selling price as per the requirement says. To change the method of production, to make or buy decision whether we should make a product by checking if it can be produced at the same facilities with a very less variable cost, or we should import the product, buy from outside. So decide about the sales mix, whether we should continue with, if a company is manufacturing 5 or 6 products, whether we should stop manufacturing a product or we should continue with its manufacturing. Okay, the term marginal cost is defined as the amount of at any given volume of output by which the aggregate costs are changed. Marginal cost means the amount by which the aggregate cost changed if the output is increased or decreased by 1 unit. If there is a decrease or increase of in production by 1 unit, what will be the change in variable cost? This is what marginal costing is. It is a variable cost of 1 unit of a product or a service, that is a cost which would be avoided if that unit was not produced. Marginal costing means the cost that we can avoid if we do not manufacture 1 unit. Say we were manufacturing 100 units, for 100 units the cost is 1000. If we manufacture 101 unit, what will be the cost? So this is what marginal costing in simple terms. So marginal cost can be presented as below. The next page chapter the next page, the table, it says marginal cost can be presented as under direct material cost, direct labor cost, direct expenses, variable manufacturing expenses, variable portions of administrative expenses, variable portions of selling and distribution expenses. So all variable cost, the sum of all variable cost is your marginal cost. Okay, we already wrote the first formula, marginal cost equal to variable cost, so that sum of all variable cost is your marginal cost. So we will go to illustration A. What does it say? Let's see. Illustration 1, sorry, not A. XYZ company makes a product, the Goldie, which has a variable production cost of 6 per unit. Variable cost is 6 per unit. And a selling price of rupees 10. Selling price equal to rupees 10. At the beginning of September 21, there were no opening inventory and production during the and there was no opening inventory and production during the month was 20,000 units. Fixed cost for the month were 45,000. There was no variable marketing cost. Okay, no opening unit during the month. 20,000 units were produced. Produced how much? 20,000 units. And fixed cost is your 45,000, right? Required, calculate the contribution and profit for September 2021 using marginal costing principle. If the sales were as follows: 10,000, if the sales was 10,000, here we can write, no, sales equal to 10,000 into selling price is 10 equal to 1 lakh. Variable cost equal to 10,000 into 6, 60,000. So your contribution is how much? 40,000. Then less fixed cost, 45,000. So your profit is negative. Simple. So your profit is negative. Similarly, you can find out for 15,000 and 20,000 units in the same manner. So what can we draw the conclusions? In 10,000 units, you can see the solution. In 10,000 units, there is a loss of 5,000. But when we increase the quantity to 15,000, there is a profit of 15,000. And when the quantity increased to 20,000, the profit is 35,000. Similarly, the contribution per unit and profit per unit are also, but profit per unit is also increasing, but the contribution per unit remains the same. You see, there is no change in variable cost, so the contribution per unit remains the same. Contribution per unit remains the same. The conclusions which may be drawn from the example are as follows. The profit per unit varies at different levels of sales. Profit per unit is varying. For the first, it is how much? There is a loss of 0.5. Then for the next two, there is profit of 1, profit of 1.75. But profit per unit is increasing with the increase in volume because the fixed cost is same and the variable cost is constant. Variable fixed cost is constant and the variable cost per unit is same. The contribution per unit is constant at all levels of output and sales, right? The contribution per unit is 444. For all the three it is 444. There is no change in contribution per unit. Then since the contribution per unit does not change, the most effective ways of calculating the expected profit at any level of output and sales would be as follows. First, to calculate the total contribution, then deduct the fixed cost as a period charge in order to find profit. We have done it same way. What the point C says, we have first found out the contribution and then we have calculated the profit, right? In our example, the expected profit from the sale of 70,000 goldies would be, they have given it, if the so now they have point D, they have given another example. If it is 17,000, what will be that? So it is very easy till now. We will move ahead. It is also marginal costing is also called direct costing. This technique of costing is also known as variable costing, differential costing, or out of pocket costing. Why out of pocket costing? Because it is the out of pocket expenditure to manufacture one additional unit. Fixed cost you are going to incur even if you manufacture that additional unit or not. You have to keep the watchman, you will keep the accountant, you will run the same electricity bill, etc. But with the manufacturing of that one additional unit, the additional cost that you are incurring is your marginal cost. That's why it is also known as out of pocket costing. The following points are noteworthy. Only variable costs are considered for product costing and inventory valuation. Only variable cost. This is what we have seen till now. Fixed costs are regarded as period cost. The profitability of different products is judged by their PV ratio. Cost data presented highlight the total contribution of each product. The difference in the magnitude of opening stock and closing stock does not affect. In marginal costing, the cost per unit remains the same irrespective of the production as it is valued at variable cost. So these are the simple points that we gone through. Then there are some features and assumptions of marginal cost are given. Today we'll conclude 3.1. The features. Marginal costing is used to know the impact of variable cost on the volume of production or output. Marginal costing is used to know the impact of variable cost on volume and output. This is your CVP analysis, cost volume profit analysis. Break even analysis is an integral and important part of marginal costing. Break even at break even point is that point. Break even point. Break even point. What is this? It is at that point where there is no profit, no loss. Where there is no profit, no loss. Right? No profit, no loss. If we put, say, this is your fixed cost. So, this is your fixed cost, then your total cost will start from here. If we add variable cost, then your sales will start from here. Sales will start from here. I think I have drawn it wrongly, no? Total cost, right? It is correct. So this is your break-even point, where your total cost is equal to total revenue. This is your break-even point. Total cost is your what? fixed cost plus variable cost equals to your sales. Fixed cost plus variable cost equal to your sale. So this is your break even point. Our concept of break even is clear. We'll go through the points. However, contribution of each product or department is a foundation to know the profitability of the product or department. So by finding the contribution per product or contribution per department, we know what is the profitability, whether the department or the product is profitable or not. Addition of variable cost and profit to contribution is equal to selling price. We just saw here. Marginal costing is the base of valuation of stock of finished products and work in progress. Marginal cost may also be used as the base for valuation of stock, but in Ind AS it does not permit, right? Fixed cost is recovered from contribution and variable cost. Variable cost is charged to production. Fixed cost is recovered from production, is recovered from contribution. In this example we saw that we found out the contribution and then we recovered the fixed cost from the contribution to find out whether we are at profit or loss. Costs are classified on the basis of fixed and variable cost only. Semi-fixed costs are also divided into fixed cost and variable cost. So it does not have the concept of semi-variable cost. It only has fixed cost and variable cost. So when there is something called semi-fixed cost, so it has to be either segregated into fixed and variable parts. It has to be divided. Okay. Then some assumptions of marginal costing. All elements of cost can be segregated into fixed and variable components. Okay, variable cost remains constant per unit of output. If the variable cost increases with the increase in output, we cannot apply marginal costing. The selling price remains unchanged. We have seen in our illustration 1, the selling price and the variable cost were not changed. So if there is change in selling price, the contribution per unit will also change. Fixed cost remains unchanged or constant for the entire volume of production. The volume of production or output is the only factor which influences the cost. Okay, we have no doubt in assumptions. Then advantages. We will go through the advantages and some limitations. Advantages of marginal costing. Advantages, it is simple to operate and easy to understand. Marginal costing is very simple and easy. Only those formulas are given. These formulas. With these formulas we can find out. I think we have understood the concept of all these formulas till now. Right? Oh, sorry. By now slowly we have understood most of the formulas. The balance also we will again revise them 4 or 5 times by the end of the chapter, so we can understand all the concepts of these formulas and then we can apply them in our illustrations. So it is very simple to operate and easy to understand. It does away with the need for allocation, apportionment and absorption of fixed overhead. It does away. We are not apportioning all the fixed costs to the products as we did in ABC costing, activity based costing. In activity based costing we had what we did, we apportioned the fixed cost to different types of, we apportioned all the overheads to different types of products. First we to cost drivers, cost centers we found out. So marginal costing does not do that. If it finds the contribution, if there are 4 or 5 products being manufactured in the industry, what it will do, it will selling price variable cost J, it will find its contribution, total of contribution less fixed cost, then it will get the profit. So it does away with the all the complexities of allocation, apportionment, absorption of overheads. Marginal cost remains the same per unit of output irrespective of the level of activity. Generally, the fixed cost remains the variable cost remains the same. If you manufacture 1 unit additional, I don't think that variable cost would impact, unless otherwise there are certain circumstances in the business happening. It is constant in nature and helps the management in production planning. So the management can do the production planning. It facilitates the calculations of various important factors. The break-even point we just saw in our previous slide. This is a very important point where the business is at no profit, no loss. If you reach this point, then only then we can move ahead. Break-even point of profit at the levels of production sales necessary to earn a predetermined target profit. We saw our sixth number formula where we understood how to determine the desired the sales required to earn the desired profit. So we are planning that we will earn a profit of 5 crores this year. So what quantity of sales we have to make to earn the desired profit, say 5 crores. So we can calculate the desired sales. Effect on profit, due to change of raw material prices. We can understand the impact of change of variable expenses on our cost and profit. It is a valuable aid to management for decision making and fixation of selling price. We can fix the selling price based on our variable cost and fixed cost. Selection of a profitable product mix. We can eliminate those products which are not even meeting its variable costs, or those products which are giving us more contribution. We can increase its sales. Make or buy decision, whether we should make a product at home or we should procure it from outside market. Problem of key or limiting factors. Say, what do you understand by the problem of key or limiting factors? Key or limiting factor. Have you heard this term? Key or limiting factor. Say there is a raw material A. There is a very important raw material A, and you manufacture 4 products. 1, 2, 3, 4. Product A, you during a year you can only have 5,000 units of A. It is a scarce resource. So scarce resources are known as key or limiting factors. So A1 gives you the highest contribution. It gives you contribution of rupees 5. It gives you contribution of rupees 4. It gives you the cost price of this is say 2 rupees. It gives you contribution of rupees rupees 3, and this one rupees 1, say 2 and 1. Okay, so which product will you manufacture first? 1, 2, 3, 4, 5. These are contribution per unit. Which product will you manufacture first? Which product will you try to manufacture more? One. It is simple. You will try to manufacture one as much as possible, and then after the demand is met for one, you have exhausted the demand in the market for one, then you will manufacture two. Because if you manufacture only one, the market may not have the adequate demand for one, right? So you have to manufacture as per demand also, your demand of products also. Then you will manufacture 2, 3, 4. So now if I say that for manufacturing 1 unit of 1, you require 3 units of A. For manufacturing this one, you require 2 units, 1 unit and 1 unit. So now for key or limiting factors, we try to 5,000 units. Other resources are not scarce. Not 3, you can say 5. For manufacturing 1 unit of this one, raw material A, you require 5 units of to manufacture 1, you require 5 units of A. But to manufacture 2, you require only 2 units of A. So which you will try to manufacture more? I think this one, because it gives you more contribution per limiting factor. So you will try to manufacture this, and for others it has a limiting factor of 1, then you will also try to manufacture this one. It also has more contribution per unit, and it also has 1. It has 2. So contribution per limiting factor of 2 and 3 are more as compared to 1 and 4, right? So you will try to manufacture 2 and 3 first. So these are decisions on key or limiting factors also. You have to take that. Determination of optimum levels. So then we'll go through some of the limitations also. The technique of marginal costing is based upon a number of assumptions which may not hold good under all circumstances. So we have already seen that marginal costing is based on a number of assumptions. We have already gone through the assumptions, so which may not hold good in the present market situation. Market is always dynamic. The separation of cost into fixed and variable is difficult and sometimes gives misleading results. So marginal costing is possible only when we are able to segregate all cost into fixed cost and variable cost. If we are not able to segregate all cost into fixed cost and variable cost, then marginal cost is not possible. So we have to say, so when we segregate the semi variable cost or semi fixed cost into fixed and variable portions, the segregation may not be as accurate and may not give us a accurate result. All costs are not divisible into fixed and variable. There are certain costs which are semi variable in nature. It is very difficult and arbitrary to classify this cost into fixed and variable elements. Variable costs do not always remain constant and do not always vary in direct proportion to volume of output because of the law of diminishing and increasing returns. Okay. Selling price do not remain constant forever and for all levels of output due to competition, discount for bulk orders changes in the general price level. So selling price does not remain constant. You will give discount to your premium customers. You will also have to give bulk discount if someone purchases in wholesale quantities. So, and selling price is determined by the market. If the demand for the product is decreased, then you have to reduce your selling price. So it does not remain constant. So these are some of the limitations. You can go through all other limitations. Tools. Now we will go for tools and techniques of marginal costing. Tools and techniques of marginal costing. We have gone through all these tools and techniques while we have written down the formulas and while explaining those formulas. First is contribution. It is just a recap of what we did in the first 10 to 15 minutes. First is contribution. By now we all know what is contribution, right? We can explain, we can solve questions on contribution. Contribution is the reward for the efforts of the entrepreneur or owner of a business concern. Contribution means not only profit but also fixed cost. It is defined as the amount recovered towards fixed cost and profit. Right? Contribution equal to fixed cost plus profit. We had seen the formula. Again, contribution equal to sales minus variable cost. Variable cost equal to fixed cost plus profit. Right? So it is not only recovery of variable cost, but it is fixed cost plus profit. It is defined as the amount recovered towards fixed cost and profit. When there are two or more products, the product having more contribution is more profitable, right? By now we know this. It is clear that the product which has more contribution is more profitable, so we will try to manufacture that product more. For example, the following are the three products with selling price and cost. Selling price A 100, 150, 200. Selling price of variable cost 50, 70, 100. Contribution is 50, 80 and 100. Which product is more profitable? Which product? Product C is more profitable, so we will try to manufacture product C more. Measure of profitability when there is a limiting factor or key factor. Again, now what we had discussed right before this, limiting factor. So now the book is trying to explain. In the above example, we find that product having more contribution is more profitable. However, when there is a limitation on any input factor, the profitability of the product cannot simply be determined by finding out the contribution of the unit, but it can be found out by ascertaining the contribution per unit of that factor of production which is limited in the given situation. Such factor of production which is limited in the given in the question is called the key factor or the limiting factor. Right? We have to consider the key factor first and then contribution. Continuing the above example, it may be explained as follows. The three products take the same raw material. A takes 1 kg, B takes 2 kg and C takes 5 kg, and the raw material is not abundant. Then profitability of the above product is determined as follows. Profitability equal to contribution per unit by key factor. What we did now, huh? Next. Profitability is what? Contribution per unit by key factor. Okay, your question may give this, so we have to use this formula. For A it is 50 rupees, for B it is 40 rupees, and for C it is 20 rupees. You have seen the same thing it is given here. Now product A is more profitable because it has more contribution per kg of material. The key factor can also be called as scarce factor or governing factor or the limiting factor or constraining factor, etc. Whatever may be the name, it indicates the limitation on the particular factor of production. Right? We had done this example extensively now, and in the question, in the book also similar example is given. Profit volume ratio or contribution ratio. Our next point is profit volume ratio, PV ratio. Profit volume ratio. It is also known as PV ratio or contribution ratio. We have written the formula for this and we have understood this also. Okay, profit volume ratio, contribution ratio means contribution per unit by selling price, contribution by sales. What is the percentage of PV ratio? So if our PV ratio is 40%, PV ratio is 40%, then what will be our variable cost? 60%. Total should be 100. Variable cost 60%. So this can also be used to find out variable cost, contribution, or such things. So you should also keep in mind this. It is useful in determining PV ratio is useful in determining of profitabilities of the products in the following two situations: when the sales potential is when the sales potential in value is limited, when there is a greater demand for the product. Okay, break even point. Next point is break even point. Break even point. What is break even point? Break even point is that point where there is no profit or no loss. Right, no profit, no loss. Break even means the volume of production or sales where there is no profit or loss. Break even point is the volume of production or sales where total costs are equal to revenue. Break even point, total cost equal to total revenue. We have learned the formulas in the point number 3, I think. Formula 3 or 4. In the book there is a chart. We have also gone through this chart where this is fixed cost, this is sales, and this is your total cost. Where the total cost meets this is your break even point. where the total cost meets the what? Total sales. Where total cost meets the total sales, this point is known as your break even point. When number of units are expressed, then break even analysis. The next point is break even analysis or cost volume profit analysis. Break even analysis is also known as break even analysis. Break even analysis, it is also known as cost volume profit analysis. Why? Because break even analysis gives us the relationship. It gives us the relationship between the cost, volume and profit. There is any change in cost or volume, there will be change in profit. So it gives us the relationship between cost and volume and profit. That's why it is known as break even analysis. Such profit planning is made with the variables mainly cost, profit and volume. Such an analysis is called break even analysis. Throughout the chart's relationship is established among the cost, volume and profit. It is called CVP analysis. This is what is written in book also. Margin of safety. Our next topic is margin of safety. Margin of safety. What do you mean by margin of safety? Margin of safety means the additional sales in excess of your break even sales. Okay? It is the sales point beyond the break even point. Margin of safety can be obtained by subtracting the break even sales from actual sales. It is used to determine the financial soundness of enterprise. Whether a business is financially sound or not. Financial sound or not, it is determined by the margin of safety. If a business has a very high margin of safety, it means that the business is more sound or more profitable. But if a business does not have margin of safety, it means that financially not sound. If it is just at BEP, it means that it is not making any profit. If there is no BEP also, it means that it is making loss, right? So we have gone through margin of safety. I think we have concluded chapter 3.1. So 3.2, cost volume profit analysis. CVP analysis. I think by now we have gone through the entire CVP analysis. We understand the entire CVP analysis, right? But we will go through it tomorrow. Tomorrow CVP analysis, break even charts and profit charts. 2, 3, 3.4, 3.5. We will try to complete till 3.5 to say on Friday. Then 3.6 we will do on Saturday. So by Saturday our chapter 3 will be completed. You can start practicing the illustrations, because we have covered most of the things, most of the concepts are covered. 3.2 to 3.5 it will be a repetition of whatever we have learned, right? It will just be a repetition of whatever we have learned till now. So you can start practicing 3.6. So we'll conclude our class today. Thank you.